Hello and welcome to the GLIO CEO Investor video series. My name is Laiken Gladwell. I'm a portfolio analyst at ClearBridge Investments, and today we're joined by David Slater, the CEO and chairman of DT Midstream. I'd like to start first by thanking GLIO for hosting this event and for the work they do in promoting the listed infrastructure asset class. David, perhaps can we start with a quick overview of DT Midstream and how the story has evolved since the spin from DTE? Over the past couple of years, sentiment has clearly improved, particularly around your regulated pipeline assets. So was it something you were anticipating in terms of the re-rate, or have you been surprised by how strong the opportunity set has been since 2024?
Great question, Lincoln, and thanks for hosting this event. Maybe I'll start. I'll step back to the spin, which was almost 5 years ago. We'll be celebrating our 5th year here at the end of the month. When we spun the company out of DT Energy, we really wanted to set up a pure play natural gas pipeline entity. At the time, there really wasn't a pure play vehicle in the public domain, in the public space. We laid out a few strategic priorities when we spun the company. One was we wanted to grow our pipeline segment. That's the segment that's predominantly regulated by the FERC, and it's also the segment that's most highly valued by the investors. We wanted to lay out a portfolio that was very clean, durable, had a lot of contract tenor in it. We laid out some financial boundaries that we were going to hold ourselves accountable to. We wanted to grow the dividend as we grew the company. We laid out some very specific financial metrics for the balance sheet to achieve investment grade, which we achieved last year. We wanted to really harvest a lot of organic growth across our asset footprint. We delivered, sizable organic growth over the last 5 years. And really, the core strategy was to create a very high quality infrastructure vehicle. We're a C Corp. We have really strong governance. We're mid-sized. So when we think about the ecosystem that we operate in here in North America, we occupy a very unique spot in that ecosystem. We're not a large C Corp, and we're not a small entity as well. We're in that mid-sized category. So it's been a strength, a strategic asset to operate in this space. There's not a lot of competition in this space. And that's really helped us execute on our strategy and our plan over the last 5 years that's brought us to where we are now. It's been an incredible journey. I'm sure the investors can look back at the track record. We've achieved really strong growth, over 300% total shareholder return over the last 5 years since we spun the company. So again, we're really focused on executing that disciplined strategy. And, we're sitting today with a really unique opportunity in front of us that I'm sure you're going to ask me lots of questions about, so I won't jump too far ahead. So,
no, perfect. That's a great introduction. Maybe just in terms of starting for the US natural gas segment, just in terms of where you're seeing that evolve over the next 5 to 10 years, particularly with the growth in LNG exports and power demand. Where does DTM sit in there, and where do you think you're best positioned to win some of that incremental demand?
Yeah, so maybe we'll just step back for a minute. I just want to paint the broad landscape, like what's happening here in North America. So natural gas in North America is the most economical fuel in the country. It's about 1/3 the price of most of the other fuels that it competes with. So in terms of just a clean, domestic, and cost-effective, affordable fuel, it ranks at the top of the stack. So that, in conjunction with really strong international LNG demand growth, and what's emerged over the last 2 years here in North America is really strong domestic demand. That's really creating a nice fundamental backdrop for the company as we look forward and harvest investment opportunities across our asset footprint.
Perfect. And I wanted to specifically touch on the Midwestern pipeline assets. You acquired those from ONEOK less than 18 months ago, and since then, customer demand has already been very strong. You've had Guardian G3 already reach FID, and there's additional opportunities around G4 and MIST that are being evaluated. As you look to the if you look to the broader Midwest, there are some peers that are looking to also capture some of that incremental growth. How do you think about the risk of double counting and, looking at those opportunities and identifying, really where DT Midstream can capture some, unique and fundamental growth there?
Yeah, you've got a series of great questions in there. I'm gonna start with the acquisition, maybe just for the background of the audience. So about a year and a half ago, almost 2 years ago, we entered into a bilateral discussion with ONEOK to acquire a collection of FERC-regulated pipelines in the upper Midwest, sort of right in our backyard, right in the region that we were incredibly familiar with from our days at DTE. And these pipelines are, purpose-built, really irreplaceable pipelines that predominantly serve utility demand in the upper Midwest in the United States. Again, those anchor customers on those assets, predominantly being utilities, we have a long history with from our previous owner. So we have strong relationships with all those customers. So when those assets came to market, it was like hand in glove fit into our strategy, our pure play strategy, our strategy to progressively grow the pipeline segment. And the group of customers that we're incredibly familiar with were already customers on some of our other assets in the region. So it was a really great fit. We were able to hammer out a beneficial deal for both us and ONEOK. And you're right, you kind of alluded to all the growth that has occurred since that transaction was completed. And we've effectively deployed about the same amount of capital into those three assets as we paid to acquire the three assets over the past 18 months. So that's just been a really good example of how this domestic demand has just flourished in a very short period of time. I think when we acquired those assets, I talked about the future growth, and I kind of laid it out into three categories. I said there's going to be demand growth. We could see already 2 years ago some of this demand coming, and that the utilities were going to be really well positioned to be able to capture a lot of this power demand, some of it data centers, but other power demand related activity. We talked about the need to modernize some of these assets and the modernization investment that they were going to require. And then we talked about what I'll call the synergies across our existing portfolio, was all these assets physically interconnect with each other and interconnect with our existing portfolio. So we have what I call this domino effect traversing across our other assets. As these assets grow, it's triggering growth opportunities upstream of them in our other assets. So it was a really nice transaction. A lot of great things have come from it. We've got more opportunity in front of us that we're busy pursuing as we speak. So we're very excited about that investment. And again, it's sort of right down the fairway in terms of the strategy. It's FERC regulated assets. Some of the investments that we've made and we've communicated to the investors have really strong multiples. So these investments are really accretive to the equity. And it's literally right down the fairway for our strategy. So we feel really blessed. The assets that we have both in the north and in the south are sitting in and around a lot of the supply growth. So our assets in Appalachia and our assets in the Haynesville are in two of the best basins in North America that are growing. And we're, the recipient of some of those benefits of their growth. As well on the demand side, still have really robust LNG demand. And now we're seeing this really strong demand materializing in the market areas. So from a fundamentals perspective, we're right in the middle of those trends, those fundamental trends, and, participating in it. And you kind of alluded to the fact that, hey, there's going to be competition, and how do we feel about competition? I'd say, we're not afraid of competition. I think this space that we occupy in the ecosystem, this mid-sized company, we're very nimble, more nimble than our large cap peers. We have the ability to listen closely to our customers and adjust the commercial arrangement to sort of dial in on exactly what they need without any corporate restrictions or, friction. We can make those decisions very quickly and act on them very quickly. So I think that's really given us quite an advantage in this market over the last couple of years, is our nimbleness, working with a customer, and then also the nimbleness on our execution. Again, we self-perform all of our projects. We don't typically turnkey projects over to an EPC type arrangement when we construct. So we really have our hand on the wheel when we're executing projects. That gives us really clear visibility into how it's going, making sure that it's executing the way we want it to. And if we have to make course corrections, we can do that very timely. And we have a nice track record here over the last 5 years of delivering projects either on time or early, and on budget or below budget. And we're proud of that. And, we intend to carry that on as we execute further going down the road. So, and on the competition side, so that's one element of competition that we feel like we have an advantage in. The other piece is that, it's a pretty robust market. Just in the upper Midwest, we can see 5 to 8 BCF a day of identifiable demand, very real demand coming in the next 5 to 10 years. We certainly don't need to win it all. If we just win our fair share, that will be a great outcome for the company, winning our fair share of that demand. And most of the utilities, we know them really well. Utilities like to diversify their portfolio. They have regulatory mandates. They have to pass a prudency test. So they will diversify across multiple providers. Again, we just need to be part of that equation. And if we get our fair share, it's going to be a great outcome for the company. And, the actions to date would say that we're getting our fair share and then some. So we just need to carry that on as we go forward.
Yeah, definitely. And you touched on that term domino effect. I did want to, as you start executing on some of these larger projects, how should investors be thinking about that broader network effect and how it can flow through some of the existing assets you had prior to the Midwestern acquisition?
Yeah, it's a great phenomenon, that domino effect or the network effect. Network effect's probably a more precise term, Laiken, than domino effect. But I like the visual of the dominoes falling over, and you can watch them go one by one, and you can sort of predict what's going to happen over time. But I'd say a great example is Guardian. We FID'd the Guardian project about a year ago, and then earlier this year we FID'd a Vector expansion. So just for the audience's sake, the Guardian project was about half a BCF a day of incremental capacity going north out of Chicago into Wisconsin. That creates a short position in Chicago of half a BCF a day because there was nothing new announced coming into Chicago. Well, then we turned around and 9 months later announced 400 million a day of expansion on Vector that's going from Michigan to Chicago, right? So it's sort of filling in some of that short position that was created by the Guardian expansion. We're in deep discussions around our storage business in Michigan. As you would expect, these utilities are acquiring more capacity. They also know that they require more storage to match up with that capacity. So that would be another domino that the investors should presume or assume that will fall as a result of these downstream expansions. And then as you do that, and as you move more of that demand pull to Michigan, Nexus is sitting there that goes from Appalachia to Michigan, that brings supply in from the Appalachian Basin into Michigan. So, that's going to create more of a, opportunity for that pipe to bring more supply into Michigan to feed that demand that's showing up in Michigan. So that nice domino effect or network effect is playing out across our footprint right now. And, it doesn't all happen on the same day at the same time, but it's quite predictable. And I'd say the Midwestern open season is another illustration of that domino effect, where Midwestern, a significant amount of the demand response on the Midwestern open season was to move more gas north into Chicago to attack some of this market growth that's occurring. So, yeah, we're enjoying that effect right now, and more to come on that. But it's very nice to have a portfolio like we have, where we have wellhead-to-market connectivity through the gathering system into the interstate pipes across the storage and to the market. It's a feature that typically investors only get with the large caps, but we have that same feature in our company. The same thing is happening down in Haynesville, where we gather from the wellhead, we bring it through the treaters, put it into LEAP, pipe it all the way down to where the staging area for the LNG terminals. So, yeah, we like the network effect.
Yeah, it's a fantastic business proposition to have, that's for sure.
It is.
So you mentioned Chicago is obviously a very fantastic opportunity, same with Michigan. I want to touch a little bit on the New York, New England markets. Can you remind investors the size and the scope of the Millennium Pro project, which you were discussing a little while ago, and how adding that capacity extending east can help some of these constrained markets?
Yeah, Millennium Pro, it's a half a BCF a day project. It would pull gas out of the northeast portion of the Appalachia Basin and bring it up into the New York, New England market area. We had a non-binding open season on that project about a year ago and had strong interest. And as I think as the audience knows, the New York, New England political backdrop has been, very reluctant to step into additional fossil fuels. Now, that sentiment has changed significantly in the last, I'd say, 12 to 24 months. To the point now where you listen to a lot of the politicians, and there's actually a recognition now that they are significantly short on natural gas capacity into the region. It's driving really high prices in the region that's flowing through to the retail customers. A lot of renewables that were supposed to be built either haven't been built or are taking longer to build or are not performing as advertised after they're built. So it's sort of compounding the capacity constraint issue that's occurring in those market areas. So that's the backdrop. We announced, I think on the year-end call or last quarter, we announced a modest expansion of Millennium. We called it the R2R Lite, which was anchored by 2 utilities and a power plant. It was 70 million a day. We felt it was really important to talk about that publicly, to be a tangible example of sort of the thawing of that market and the realization that there's a significant capacity short in that region. Algonquin, who is the pipeline that we deliver to, that is a direct line up into New England, they're in the process of working through 2 significant projects. Both those projects are sourcing gas from Millennium as the supply source. So, I'll talk more about Pro in a second, but the original R2R, the larger version of R2R, is sort of resurrecting right now with what Algonquin's doing. So again, a lot of conversations right now with these utilities in this region, and they're really, really looking for incremental capacity into the area. So we're optimistic that we may have a new version of R2R that could commercialize. And if I go back to Pro, 2 things. There are 2 fundamental ingredients for Pro for us to move forward. One is we want to have a New York utility sort of deeply involved in that project, to demonstrate to the state of New York that there's a local benefit, there's a local advocate of the project. There are tangible benefits to New Yorkers of the project. And we want to hear clearly from the state administration that, they're not going to oppose the project. And that's just a function of what's happened in the past in the state of New York. So we need to be very careful before we would ever commit sizable capital to a project in that region. We do not want to have what has happened to some of our peers in the past, where they begin executing a project and then, you get the big X and you get caught mid-flight in execution, and that's never a good day for anybody. So we'll be very careful there, but really optimistic that the sentiment is changing. The realization that there's a capacity short is there, and customers are becoming very sensitive to affordability. And like I said in the opening, natural gas is a third the price of any other fuel. So affordability is very real for customers in New York and New England. And there's a huge opportunity there to reduce the costs, like materially reduce the costs to consumers in that region by expanding the energy infrastructure that serves that area. So lots of good things happening, but we're going to take it one step at a time and be cautious, just given the history there.
Yeah. It sounds like there's a lot of exciting projects on the horizon and in the current backlog. Can you walk us through how that translates to durable EBITDA growth over the next few years? And as activity does start to ramp, are you seeing any increase in execution risk, whether that's supply chain, labor, permitting, things like that?
Yeah, those are great questions, Laiken. Let me just set the backdrop of what is that investment agenda that we have, and then sort of where are we on that journey, and then what are the issues that we have to be really mindful of to execute well. So we laid out a $3.4 billion capital backlog on our year-end call, which was about a 50% increase from the backlog a year earlier. So that just gives you a sense of, the opportunity set is quite robust and growing. It still feels like it's growing as we sit here today, that there's momentum that's carrying it even higher. We've FID'd about half of that. Just again, I think we FID'd about 1.7 billion. So, we're feeling very confident in that backlog. And again, just for the audience's benefit, that backlog is not the gross backlog. The gross backlog is multiples higher than that. This is the shrunk down backlog, where the management team is promising to the investors that, hey, we're going to execute on this amount of capital. We're not going to get down into the project level specifics until we FID projects, but that's the size of the opportunity that's in front of the company that we're executing against. So yeah, that's a really exciting backlog when we think about the opportunity set. So half of it is FID'd, so half of it we're in flight on right now, executing, right? So Guardian 3 is a big chunk of that FID backlog that, we're in the FERC process. We're actually commencing our open houses with our stakeholders in the region this week. We're well on our way of acquiring a right-of-way. So the ball is rolling in the FERC regulatory process. We'll likely be filing that application shortly after we get through the open houses. But yeah, everything's rolling along as planned and as expected. And sort of like we alluded to earlier in the call, with this big infrastructure requirement coming in North America as demand is growing, there'll be a lot of pressure on execution, a lot of pressure on some of the input costs to these projects. So buttoning them down, nailing them down early is going to be a key element of successfully executing these projects. So again, for Guardian, literally the day we signed those agreements, we were executing the purchase order for the compression and locking in the pipe costs and the delivery. So we were doing everything we could to fix really big chunks of the input costs into those projects. Just to manage that, knowing full well that when you get into a robust environment like the one we're walking into, there's going to be cost pressures all across the board on the input costs for these large projects. So you have to nail things down early and fix them. And you have to make sure that you're carrying appropriate contingencies in your CapEx budgets to allow for and accommodate for what you know will happen that maybe hasn't happened yet, but a year or 18 months down the road, you know there's going to be cost pressures and you need to carry enough contingency to be able to handle those cost pressures and deliver the economics that we laid out to the investors when we FID'd the project. Now, if we can pull those costs back, stay within budget, come in under budget, that just enhances the returns for the investors and would be a great day if we can execute really well. But we just want to make sure that we're for sure hitting the mark that we lay out to investors and can achieve that with high confidence. So,
yeah, perfect. And just on the M&A side, how are you thinking about the M&A landscape today and where DTM could play a role as the industry does continue to consolidate? Are there any specific types of assets or geographies that would particularly complement your existing footprint?
Yeah, we get that question a lot. And, it's an interesting question to ponder when you're thinking about allocating capital. And that's kind of one of the key roles that I play at the company is, okay, where are we allocating the capital and why? With this really robust organic opportunity set that drive these really attractive multiples, which drives really accretive, accretive to the equity. When you look at M&A typically transacts at a higher multiple, right? Mm-hmm. So, you're like comparing M&A multiples with organic multiples, and organic will win every day. But then you have to look at the strategic, element of M&A, and again, our portfolio is very clean, very predictable, gas only. We have no commodity exposure. Highly contracted portfolio, all those features that we built into the portfolio over time, we want to maintain if we're doing M&A, right? We don't want to contaminate the portfolio with M&A that doesn't have the same flavor or the same strategic intent as the rest of the portfolio. So when you start applying those filters to transactions that are floating around in the M&A world, it filters out a lot of transactions pretty quickly because we're really looking for that high quality addition to the portfolio, like a lot like the ONEOK transaction, right? That was high quality addition right down the fairway in terms of the strategy. The Millennium purchase that we did 3 years ago from one of our partners, again, right down the fairway, growing the pipeline, asset that we know really well in a market that we understand deeply. So these are the things that we think about when we think about M&A. And there's always a lot of assets in the market. I'm always surprised. There's just constantly assets in the market. So we're just trying to be really disciplined with the strategy execution, applying those filters. If it doesn't get through the first wave, the first level of the filters, we don't want to spend too much time on it and distract our attention away from organic execution. Mm-hmm. But if it gets through those filters, then we'll take a hard look at it. And, we'll assess its strategic value, the network effect, like all those other features that really don't show up in a headline multiple when you announce a project. Yeah. And assess if it makes sense to add that to the portfolio or not. Smaller bolt-ons are a lot easier and more comfortable to do. When you're just getting something in your backyard and it's not that material and you can just nicely bolt it on, and over time those things add up. Mm-hmm. Larger, more corporate or strategic transactions, it's a tough environment, right, to do those in when you got this really strong organic. Now, I will say this, I will compliment our CFO who's probably listening. He's done a great job with the balance sheet. We've got, investment grade. We have, we're sitting sub 3 times on the leverage metric. So we've created a lot of dry powder on the balance sheet that can be deployed to M&A if the right opportunity presents, or it can be deployed to more organic if more organic presents. So I feel like we're in a really good spot in terms of, corporate optionality. We have really strong currency. Currency is trading really, really well. We have a lot of capacity on the balance sheet that is unspoken for, which gives us a lot of optionality. And we're sitting in a really strong fundamental environment right now, both on the supply side and on the demand side. So, it's our job to commercialize all those good things happening around us. And I know the organization's really excited about that and working on that. And it's been really, the last 5 years has been gone by so quickly, and it's been a lot of fun. So looking forward to the next 5 years.
It's been a fantastic track record so far. So David, just as a last question, where can people find more information about the company, and if investors want to do a little bit more digging on exactly that fantastic track record?
Yeah, probably the easiest place to go is to dtmidstream.com, which is our website, and you'll be able to get a good overview of the organization, the footprint, the asset footprint, where we're at in the country, and you can click down on the assets, get a little more information. Another good place to go is to the FERC website. Like all of our FERC assets, it's 100% transparent. All that information and operational history, customer contracts and counterparties all sit out on the FERC website. But the most simplest place to go is to call our IR department, and they'll do all that work for you and give you the answers and send it over to you in a timely fashion. So those are the three places that I would recommend you go if you're looking for any particular information. So
fantastic. Well, thank you, David, and thank you everyone for joining us today. Don't forget to keep an eye out for the next interview with the GLIO series, and all the best. Thank you so much, David, for your time.
Laiken, I need to thank you for hosting and asking these probing questions, and I want to thank GLIO for the studio here for setting this up and preparing this. So we look forward to seeing you in person, hopefully in Sydney soon. So
exactly. Thank you so much.
Thank you, Laiken.